Friday, the 5th of September, 2025. And what is happening? Well, on the Bitcoin and alts market, we're seeing Bitcoin and a whole bunch of altcoins and meme coins make some movement to the upside following the returns as the price action does. After hitting some nice little lows relatively for the week yesterday so far, and climbing up a little bit steadily since then. Um, but that doesn't mean that it's necessarily over with the dumping. It might be for now, but very often we see Bitcoin kind of a sharp spike down for a little walk back up. Again, doesn't mean we're going to see it necessarily now. It might be that we've had a relatively soft landing and kind of curved that one out nicely to the downside without a spike of some kind. Um, but those spikes do happen, so be aware if you're in a long position. And the spike down, maybe it's temporary, or maybe it begins a further decline. We'll see. Uh, but yeah, it is possible. Obviously, there's always probabilities to the upside and downside and sideways. And for now, we're seeing assets across the board basically making slight movements to the upside and on different time frames you're seeing the assets move along with the volatility and entropy and random walks on certain time frames and trending moves on others, as it always will be the case. And same with the volatility. It's been pretty good indicating to the upside across the 4 hour and lower indications. And for now, it looks okay to the upside. At least it did last I looked at the asset about 10 minutes ago. Maybe it's changed now. This is crypto after all. But the point is, in the bigger picture, right, it could very well be that we see a little spike down, bounce right back up, and begin to climb. Or it could be that it just keeps spikes down and continues to go down, or it could just continue to climb here, or it might even just go sideways for a while until the next move. Maybe it'll go sideways and up, sideways and down. Who knows? We'll see. Right? One thing's for sure, right? On the intraday time frames, there's lots of good volatility to trade with, and on the bigger time frames, people are like worried: is this the end of the bull run? Remember, there's really no such thing as a bull run or a bear market. Those are just terms people popularized to make it easier to comprehend. What's that really happening, right? What's really happening is extended periods of buy pressure that people call a bull run, and extended periods of sell pressure that people call a bear market. But in both of those cases, there is buying and selling happening. Every trade has a buyer and a seller, right? And it merely depends on which direction the market goes at any given time to determine who will be the winner and who will be the loser of any given trade. So, that's why it's important to keep in mind, right? Like how very important it is to trade low time frame volatility, entropy probabilities, and statistics, because there are so many occurrences of opportunity in a given day. But if you start swing trading it, you do add a lot of risk to your trades, especially if you use leverage, which for most people, really, if you're putting in $5, $10, $15,000 or more into trading, there's really no excuse for it. I know you want the bigger gains faster. I know. And in some case, maybe you know what you're doing with leverage. Maybe maybe you know what you're doing, and You're not going to screw it up, as important as each trade is for your long term goals or maybe your shorter term goals. But if you can avoid using leverage, you really should, especially in crypto. Like, because you actually don't need it, right? If you have a decent sized portfolio, even just like a normal entry level one. I'm not even talking about like if you built it up to hundreds of thousands of dollars. No, if you have even like anywhere from 5 to 20 grand in your portfolio, and the average size of an entry on an exchange for first time traders, it's around it's around 5 grand, somewhere between 3 and 9. But like the average is really closer to 5, or the mean is actually closer to the median, whichever median is actually closer to 5 grand. And but plenty of traders put in 10, 15, 20 even the first time they trade. And if you traded even for a year or two, you might have that much on a trading account, unless you've lost it all, like most traders. But you still might have that much because maybe you have more money, and you figure, hey, it's okay if I lose 5 to 10 grand a year on this thing. At least I'm trying. Meanwhile, my stocks are doing okay. So you don't think about the money you're losing on your trading account. Well, if your goal in trading is to increase your P&L, then you should care. You shouldn't accept losing 90% of your trades. You shouldn't accept losing all of your capital, right? Those are things you should avoid doing. And the way you can avoid doing that, first and foremost, is to take your profits, limit your loss, aloha, and don't be emotionally attached to your trades, right? Those are the three key rules of trading, which follow the overall arch or guiding principle of, man, you don't have risk management, you got nothing. Right? Without risk management, you got nothing. You got to be able to manage your risk. You can't manage your risk, trading is not for you. And by managing your risk, I don't mean putting in a stop loss and a take profit into the system. You should be running those manually. You shouldn't be leaving your trading station with trades open. Right? You don't swing trade this stuff. It can go against you very, very, very fast, like in a second. Right? It can just snap down or snap up against your trade. Like if you're in a short right now and the market's going up, and you don't cut your losses, why? Because you don't want to lose a dollar. Because you don't want your last 30 trades or 10 trades to be followed by a loss of a dollar. Well, what if it keeps going up instead of losing a dollar? You lose $5, $10, $100, $1,000, $2,000, $3,000, and then eventually $5,000 in your new account. Your 5K sitting in there is liquidated. Is that really what you want? Because that happens to most traders, most retail traders, not professional HFT traders and quant shop traders, but most retail traders. And by the way, it also happens to a lot of professional traders who, for some reason, still use traditional technical analysis, because there are some shops that are considered professional, but they use traditional TA, so it's really hard to call them professional. Like, they're just holdouts from like the 1960s. They refuse to get with the times that have been around since literally the 1970s, when Black-Scholes, when the Black-Scholes formula was introduced to Wall Street, and this whole options trading with volatility thing changed the nature of trading on the market, and professionals switched over to that pretty quickly during the 1970s. And by the 1980s, it was the dominant thing that people were using. By the 1990s, you had long-term capital management, and they were doing incredibly well with Black-Scholes formula as their main driver. And of course, they screwed up with, some states, arrogance, but I say more, they just didn't have the right information to know. Right? They weren't correlating it the way that we do. There were some things they just didn't know about what we know already now. We're standing on the shoulders of giants, but we have learned things as well. For example, we discovered at Alpha Trading, how to use our RMLR to predict something very important about the future. regarding distribution and mean reversion, right? Which no other group has discovered before, as far as we know. Um, so that's I mean, lots of people. Anytime you have lots of people studying something, there will be some that discover some things, right? I'm not saying we're the only people who've discovered anything. No, I'm just saying that's, for example, that's something we did discover, among other things, right? Or that we invented, you know, we created, I should say, first. So the math existed, but we just created the visual for it that nobody had ever created. For example, with the Laplace distribution. So like nobody that we know has ever put together a Laplace volatility radar or Laplace volatility tool like we have, right? So instead of normal distribution, we just use Laplace distribution for it to give us basically the equivalent of our alpha volatility radar that uses normal distribution, and it's the exact same looking visual, only instead of normal, it uses Laplace distribution. And it's built into our volatility radar. The point of all that is to tell you that the traders who win use those kinds of maths, right? The kind of maths we use. Yes, they have different visuals. Yes, they have different tools, but they're using the same maths. That's why we use them, right? Because that's what actually runs the markets. Not because it's what we want to run the markets, not because it's what we prefer to run them. It is what runs the markets. And if that's what runs the markets, then that's what we're going to use. If you told me that actually what runs the markets are the leaves on this tree right back here, right? If I knew that I could just read the leaves on that tree and it would tell me how to trade better, that's what I would do. Right? If I could look at the asphalt on the road when I'm driving and know that that's what makes me a better trader, then that's what I would do. You know, but it isn't. What is relevant to trading is the mathematics, standard deviations of returns, etc. And that's why when you look at the markets of these mathematical protocols called cryptocurrencies, namely like Bitcoin, Litecoin, Ethereum, etc., XRP or whatever you want to get into it. When you look at how these things are created and built and maintained and run, and you look at how they're moving along through their history, through their life cycle, you realize how few people in the world actually use this stuff. Then you kind of have to acknowledge at some point that we are in a phase now that is very different than anything we've ever seen before. I don't just mean crypto, right? But finance in general is radically changing. Finance is evolving at rates that we've never seen before, right? Because we have the advent of computer technology, digital connections, high bandwidth, and all that. And at the same time, we have new innovative financial solutions, financial assets, financial products, financial markets, financial asset classes that just never existed before, right? And those financial asset classes that never existed before, and all the things within them, they're not yet used by the average person on a day-to-day basis. Yes, a bunch of people might have some crypto in their wallets, but they don't use it day to day, and they certainly don't understand it or comprehend it very well on a technical level. Certainly not, and definitely not on a trading level. So we are still, even though we're not at the very, very beginning, we're not, we're no longer at the point where, we're making the initial discoveries. No, the initial discoveries we've already made. Now we're 16 years into it, and sure, we're making plenty more new discoveries, right? But it's been around for 16 years. It's been around for longer than that, but cryptocurrencies in the form of Bitcoin and things that came after it have been around since, white paper in 2008 and the network launched in 2009. So, the assets will continue to move according to the VEX very well for probably a long time because the assets are still relatively new and have plenty of good information to move through on a depth level that you would expect to see even during wild and crazy times. Right? You're going to get great big spikes and great big spikes and to the upside and the downside. It's going to happen from time to time. You're going to get a lot of insane performance to the upside and the downside, right? And you should be neutral on whether you care about whether the trade goes up or down because it's completely moot. You should just be on the winning side of trades, of most of your trades. That's really all you need to do. And if you're not on the winning side of most of your trades, that's why you need to limit your losses because you should be winning most of your trades. I like to put it like this: you should win at least one standard deviation of your trades, right? 68.3% of your trades, consistent, and limit your loss to the same amount, whether it's 10 cents, a dollar, $10, $100. I don't care. I don't know what your financial situation is. Whatever you consider to be a tiny loss, right? Something very, very bearable, right? It should be less than 1% on any trade. You shouldn't be losing more than 1% of your trading capital on any trade. And yes, that includes if you're using leverage. So if you're using 5x leverage or 10x leverage, then yes, you'll get to 1% 5 times faster than if you're using no leverage, than when you're using 5. Or if you're using 10x, you'll get to 1% 10 times faster than if you're using no leverage, right? So 0.1% on no leverage equals 1% equals 1% on 10x leverage, right? You shouldn't lose more than 1%. Okay, if it's 1.05, whatever, because you didn't close the order fast enough, so be it. But if you ever get to 1% and you haven't closed your trade yet, you probably should. Because it's a whole lot better to lose 1% and be able to run the next trade with 99% of your capital left going in the right direction. And you don't have to immediately jump back into the trade, right? Wait for the trade to play out if you've already missed it. If it's moving too rapidly, don't just jump in like crazy. Wait for the information to confirm that that's what you should do. Once you do that, then get back in the trade. With 99% of your capital, you'll make that 1% up very quickly if you're in the right side of the trade. But if you wait and wait and wait, that 1% might slowly grow or quickly grow to 2%, 3%, 5%, 10%, and so on. And then it might take a very long time to go back up, if at all, or go back, get you back to zero, if at all, let alone in profit. And that's the painful part that you shouldn't want to chase. Anyway, that's it for now, folks. See you. Peace.